We're tracking the flow of funds. We've developed a handy little tool that measures the flow of capital between the different sectors in the S&P 500. We're going to show you some pretty strong, obvious trends and some that may just come as a surprise. Well, this is no surprise. The strongest stocks, they're still leading. Of course, we're talking about the Magnificent Seven. Nvidia, Apple, Google, Meta, Microsoft, Tesla, Amazon, the strongest of the market this year, up 8% in November so far, 46% for the year. What's not been strong, energy prices. Now, we're going to show you in just a moment, inflation has come down, but not core CPI and core PPI, the standard measures, in large part due to declining energy prices. We're talking specifically about the stocks like ExxonMobil and Chevron, collectively known as the energy mineral stocks. That's down 4% for the year, which really stands in stark contrast to equity markets that are hitting new highs. Now, here's CPI Gasoline on a year over year basis, down 12% this past report. Before that, down 15%, and before that, 10%. So, energy prices have really been the weak part of the market, accurately reflected in the CPI. Now, stocks don't like high interest rates. Take a look, and this is a really interesting study. Yellow line, that's the 1 year US Treasury bond, that's the yield. The blue line is a 10-year. The white line are Fed funds. Notice what we saw here in the month of April. The 1 year Treasury notes, the yield almost literally touched Fed funds rates and then moved to the downside. Now, it's important to note the short-term bonds, like the 1 year, they tend to move in anticipation of higher, lower interest rates. So what was this telling us in April? That the economy was strong, or I should say the inflation rate was strong, and the Federal Reserve, well, they were not expected to lower interest rates very aggressively because inflation was still a very big threat at that point. Well, notice what also happened in the month of April. Very weak stocks. This by far was probably the worst month of the year, coinciding with that peak, that spike on the short-term maturities. Putting this all together, it's telling us that because inflation, the threat of inflation was still very much at the front door, the stock market didn't like that, and that's why stocks really remain so weak. So where's the money going now? And there's a couple obvious trends. Starting out, we know banks, they like lower interest rates. They're up 10% for the month of November so far. Of course, there has been a post-election rally as well. That should not be discounted. But overall, banks do like low interest rate environments, and that certainly is obvious with this month's performance. The Magnificent Seven, well, they're still trending. Again, they're up 8% for the month of November. Little reason to believe that that's going to end. But there's also a new market trend which may come as a surprise. We're talking about a group of stocks known as industrial services. Now, think of the AI technology. They demand a tremendous amount of energy. The energy consumption, it's thought it will come from companies like Schlumberger and Halliburton and many others. So we see those stocks have really started to move, to the upside in anticipation of the greater demand. Now, what about the Fed? We had meeting minutes that were released earlier today. Specifically, the Fed released their minutes from the last meeting, and they said, in part, policymakers are taking a cautious approach to cutting interest rates. They have to see that inflation is not going to go back to the upside, and of course, they're also watching the jobs markets. Take a look at the Fed funds futures. Now in blue, we're taking a look at the 425, 450 level, and this is again for the December meeting, the anticipation of a quarter point cut. In red, this is the anticipation December. The Fed will not cut rates. Take a look at the market reaction today as a result in part of the Fed meeting. The odds that the Fed will cut rates in December rose from 52 to 65%. The odds that the Fed would not cut rates in December dropped from 48 to 35. So keep in mind what we've seen so far about first that 1 year Treasury note moving up, creating weakness in the stock market. Well, this looks like it's pointing in the opposite direction. And remember also that sector that tends to do very well with lower interest rates, like banks. This week we have, well, it's a short week, but we have a lot of news. Durable goods, retail sales, retail inventories, we should say, GDP, the first revision, and the personal consumption expenditure all prove to be very important. And we're going to watch the Fed funds futures in the bond market to see if it'll give us any hint about future trends to come. We hope this has been helpful. We look forward to seeing you back soon.